tomorrow? Let's bring in our floor show traders, Scott Fulman and Tom Hayes. Tom, what does the price action of the past 48 hours tell you about how people should be investing, particularly ahead of the Federal Reserve meeting?
Yeah, well, Liz, we believe the majority of the pain is in the rearview mirror at this point. Historically, you don't get a 20% correction in the S&P 500 without a recession, and you don't get a recession without a yield curve inversion. While the yield curve has been flattening since June, it's nowhere near an inversion. And then finally, recession is 2 quarters of negative GDP growth. We're going to have positive 4% GDP growth in 2022. So this was needed. Sentiment has washed out. We saw that in the AAII individual survey last week, where bullishness was only 21%, bearishness was 47%. That usually happens near inflection points. To your point on the VIX, it got up to 38 yesterday. It's down to 29 today. And finally, the put-call ratio. People buying insurance, put options yesterday got up to 1.26. People were buying insurance while the house was on fire. You want to buy insurance before the house goes on fire, and they were buying it at the exact wrong time. That's also a sign that we see during times that the market turns around. So those are the 3 indicators we saw at extremes, and I think we're seeing the reversal here.
Scott, Tom Hayes just went out on a limb and said, we're pretty much through this, but this whole discussion could be moot if tomorrow the Fed comes out and strikes perhaps a much less aggressive tone about rate hikes this year. I mean, if that's the case, couldn't we see a massive rally in risk assets? I mean, should investors be preparing today for that possibility tomorrow, and how?
So, Liz, first of all, over the weekend, we were noticing that we were coming towards a capitulation point. And yesterday morning, we saw the Dow was down, and we saw a formation in there that said, okay, we have a first measured target now going back up to 34,500 on the Dow, and we hit that just a little while ago. But here's the thing. The big key is not necessarily the Fed overall, it's oil prices. Oil is the thing that is scaring people more than the Fed tightening and raising rates. And the fact is that is where a lot of the inflation is coming from. Big scare is if the Ukraine is invaded by Russia and the economic sanctions go in, that's going to be the point we're going to see oil potentially go up to $100, $103 a barrel, and that can really shake the market. But overall, if you take a look at the big macro picture, it's still the same as it's been for investors. There's really no other place to put your assets where you have liquidity and you have the possibility of earning more than the rate of inflation.
Well, exactly. And, if anywhere you're going to see inflation, it's definitely been energy prices. If you look at the S&P leaders right now, you've got Apache, you've got Halliburton, you've got, Occidental Petroleum. So it's not a surprise here. But Tom, again, I mean, I just want to make sure you truly believe that we're done with this at least 1,000 to 800 point losses here and there.
I think in the short term, what we need for a tradable bottom, Liz, is we need a continuation of positive tech earnings, because that's been hit the worst, like we saw with IBM last night, beating on revenues in a big way. That was helpful. Microsoft is critical tonight. So we need to see solid earnings. We need to see the growth from Azure and the hybrid cloud. And finally, we need to see the Fed back off this idea of starting quantitative tightening with the first rate hike, which could be as early as March. That spooked the market 3 weeks ago, and I think that's attributable to a lot of this volatility that we've seen was those Fed minutes starting quantitative tightening. Historically, they wait 12 to 18 months to start that. If we get those 2 things, I think this is viable, and I think we could have a nice move in coming weeks. We're looking at the biotech space to take advantage. It was a terrible performer last year. We're playing the mean reversion trade as people go back to their doctors and restart treatments for other ailments and focus on things besides COVID.
Well, I can tell you when it was viable. Yesterday, midday, when we were down 1,100 points on the Dow Jones Industrials. And then had you really caught the bottom there, you'd be definitely in the money. Everybody, I just want you to write this down. Microsoft, okay, it's down about 1%. Expectation, $2.31 for EPS, $50.8 billion for revenue. And that, by the way, would be an 18% gain year over year. Scott Fulman, Tom Hayes, great to have you. Thank you so much. Dow Jones Industrials up 69 points right now. Let's get to this Fox